Hey, what's up guys? Welcome back to the channel. My name is Frank Mularcik, and in this video we're going to be looking at my M1 Finance portfolio that I cover just about monthly on this channel. And most of these stocks are a little bit more risky, a little bit more of growth focused companies. Most of them don't pay dividends, and I definitely don't pay as much attention to this portfolio at all. I just kind of let it do its thing. And if you guys have been paying attention to the markets recently, they've definitely been dipping a fair bit, especially a lot of these companies that I do own in this portfolio have been hit pretty hard over the past few weeks. So it'll be interesting to check in on this portfolio, see where we're at. So like I said, I do use M1 Finance for this portfolio, and you can see the value right now is $595.19. And it says our net cash flow since we started has been $726, and right now it's right around $595. Like I said, it says that our return is negative 34%, but it has a weird way of calculating that. And if you just look at, the $595 divided by the $726 that we initially invested, you will get something else, which we're actually going to do that calculation right here. And it looks like that in reality the portfolio is down 18.1%. So obviously that's still a fair bit, but we're going to look through some of the holdings and see how they've been doing. The biggest holding I do have is VGT, which is Vanguard's Information Technology ETF, and that one's up about 4% since the beginning. And again, all these percentages are based on their calculations. I'm going to go in depth a little bit more into some of them as well. So RKK is about 10% of the portfolio, and that one says it's down 54%. But if we look here, it says our net cash flow into this position is $92, and it's currently worth $59.82. So again, if we're going to do that calculation, $60 divided by 92, that's about 65% of the original value. So that means it's down about 35% in reality. And then next here is Shopify. This one, it says, is down about 50%. But the interesting thing, this one's about 9% of the portfolio. The interesting thing here is that this one was actually up like 7% today or something crazy like that. We look on the day, yeah, it's up 7%, which is kind of crazy. And I'm recording this right now on Monday, January 24th. This video should be coming out Tuesday. But my average cost on this one is $1,224, and the current share price is $938. So that's really not that bad at all. Not down anywhere close to 50%, only like 24% down on that one, which is still a fair bit, but it's not anywhere close to 53% like it says from that calculation that they do. Google still going strong, up about 15%. Obviously, I think I was up a lot more on that one before. PayPal also about 9% of the portfolio. It says we're down 60%, which honestly is a crazy number. But our average cost here is $235, and the current share price is $162. So again, if we do that calculation, it gets us to being at about 68 to 69% of the original value, which means we're down about 31 or 32%. So again, not nearly as bad as this kind of indicates. This is called the money weighted return, which takes into account like how often you contribute and how much you contribute at what prices, which I guess sort of makes a little bit more sense to take those things into account. But just looking at it as a percentage doesn't make the most sense to me, at least. Amazon, it says we're down about 23%. That's about 9% of the portfolio. Then Tesla here is about 7% of the portfolio, up still pretty nicely on this one, up about 41%. I mean, I remember, at one point we were down probably like, it said we were down like 40 or 50%, which is pretty funny. And now it says we're up 41%. So looking right here, our average price is $728, and the current share price is $930. So if we do 930 divided by 728, we're up about 27.7% on that one, which is pretty cool. And then going down here, Adobe is the next position. That one's down about 15%, so pretty close to breaking even on that one. MasterCard also about breaking even, down about 2.46%. Visa down about 14.6% on that one. And then Jumia, this one says we're down 89%, which is really quite scary to think that your investment is down like 90%. But if we look at the actual share price, my average cost is $17.24, and the current share price is $8.28. So still down over 50% there. But if we do the calculation, it looks like we're down about 52%, which is not nearly as bad as 90%. So this company, I was actually looking at some stuff on Jumia recently. They are basically an e-commerce company in Africa, and I think their third quarter results came out in November. I think it was third quarter 2021, and those results were pretty good. Maybe that's why there was this fairly big spike up there. That might have been just me adding more money to the position. I'm not entirely sure. And they released those earnings around November, sometime in November, and they were really not that bad. They were actually pretty good, especially compared to other earnings numbers they posted over the past year. So their gross merchandise value, which is basically the total value of everything they sell, that was up year over year like 15 or 20%, whereas like a year ago it was down year over year like 10% or something like that. So honestly, those are some good signs with Jumia, and I think it could be a little bit of a turning point for them. We'll have to wait a few quarters, but honestly, I'm perfectly happy buying the stock at $8 every few weeks in this account. So I'm really not too worried about this position, just because I'm getting a pretty good deal right now, and slowly I'll be lowering my average cost, and hopefully at some point those gains will just be bigger than they could have been if the share price didn't get this low. So really, even though it says we're down 90%, I'm honestly not too worried about that one. Spotify is next, and this one says we're down about 36.92%. My average cost is $240, and the current share price is $193. So if we do that calculation, then we are down just about 20% on that position, which Spotify is a company that I think is a great company, and I think the stock price in general is has been and still kind of is a little bit disconnected from the valuation, but it is a great company that I do want to own, in the long run, and I think they'll, still provide good returns in the long run. So that's why I am buying it, every few weeks when M1 Finance does these buys automatically for me. And the last one here is Square, or they renamed themselves to Block now. This one says we're down 82%, and this one has really just been absolutely destroyed the past like 6 months. So my average cost is right around $198 per share, and the current share price is $117. So if we do that calculation, then we are down about 41% on this position, which is, again, really not nearly as bad as the 82% that it says that we're down. So a lot of this value, has been just wiped out over the last few weeks and few months, even though, since, the beginning of November, I've still been contributing, to this position every few weeks, but the value really hasn't moved that much, and it's actually gone down a little bit, just because the stock price has just gone down so much over the past few months. It's really astonishing how quickly it's gone down over the past few weeks even. And so again, not really something I'm worried about there. And overall for the whole portfolio, it says we've contributed $726, but some of that net cash flow is from referrals. So we actually go over here to our funding history. We contribute $100 in 2020, $380 in 2021, so that's $480, and then $55 so far in 2022. So that brings us to a grand total of $535. So we've only really contributed $535. So really we're positive on the positions, which I'm happy about. That's, I guess, one positive we can say for the portfolio. And if we want to look at the activity here, just been doing my weekly deposits. I actually, at the beginning of 2022, I upped it to $15 per week. So that means I should be contributing about $60 per month. So we should see a little bit quicker growth and just contributing a little bit more, which will let us buy more often and buy more stocks and more shares in these companies that I want to own. And like I said, some of those contributions are from referrals. So if you do want to sign up for M1 Finance, you can use this link, and basically I think for a few more months until sometime in February maybe. If you sign up with my link, you get $50 and I get $50 as well, straight to my portfolio whenever you deposit $100 into a regular account or 500 into a Roth IRA. So it's really a great deal, and their platform is super easy to use. You can set up these pies, and it just kind of automatically buys them buys your companies at the specified percentages whenever you deposit money. So it's pretty nice. I do like it because it's pretty hands off, and I really don't have to do much work with the portfolio, which is nice. But you can also, make specific buys if you do want to. You can only make those buys in those trading windows, which, if there's a really good deal intraday, you can't really take advantage of it. But in the long term, that probably isn't going to matter that much either. So if you are interested, definitely sign up using my link. And I think, even if you sign up after sometime in February, whenever that specific promotion ends, usually they still have it either like $10 or $30 you get when you sign up. So it's really never a bad deal. And I would definitely recommend it, especially for beginners. So let me know what you guys think of this portfolio and the companies I own, and let me know how your guys's companies and stocks have been doing that are a little bit more growth focused and not focused on dividends. Really be interested to hear what you guys have been investing in recently, and just want to thank you guys for sticking around to the end of the video, and I'll see you in the next one.